Mohammed, please mute.
So good evening, class. You're welcome to another class again. Tonight, we are going to be looking at IAS 21. I would explain the core principles to you, and we'll be able to solve last diet question 1, and we'll round up the class on that note. So what is IAS 21? So IAS 21 is about the effect of changes in foreign exchange rates. The effect of changes in foreign exchange rates. So basically, the objective of this standard looks at the fact that entities generally can actually carry out foreign activities in 2 ways generally. They can carry out foreign activities in 2 ways. The first is that they may transact in foreign currency. They may do transactions in foreign currency. That is, you're in Nigeria and you're buying goods in another country and you're looking for another currency. Like what is happening in Nigeria right now, where a lot of us want to buy imported items. That is transacting in foreign currency. And another one is that an entity may have a foreign operation. They may have a foreign operation. So a foreign operation is like, okay, a subsidiary, a branch, a partner, a segment that is located in another country. So those are the 2 ways in which foreign activities can be carried out, either having a transaction in foreign currency or having a foreign operation. And in some instances, that foreign operation, of course, will present his financial statements in a foreign currency. So what this standard wants to look at is, 1, that foreign currency transaction and that foreign operation, how do you include them in your financial statement? And when you have now included them in your financial statement, then you then need to then translate your financial statement into your own presentation currency. So the focus today, tonight, what I want to teach you is when an entity carries out foreign currency transactions, or if it has a foreign operation, like a foreign subsidiary, like a foreign branch. You are in Nigeria, you now have a foreign subsidiary in Ghana, or you have a subsidiary in Paris, or you have a branch in London. That is a foreign operation. How do you include them in your financial statement? How? That is the discussion for tonight. You see, it's not hard at all. Very straightforward. The key challenge you would see is which exchange rates are you using? Which exchange rates? That is the key challenge. Exchange rate. So we'll focus on how you identify the exchange rate to use. Ultimately, you would then be able to include those transactions or those foreign operations in your financial statements. So from what I've said now, I will teach you how to account for transaction and balances that you have in foreign currency. I will teach you how to translate result and position of a foreign operation that you included equity method or consolidation method. We'll show you how do you translate those ones. And then how do you translate result and position into presentation currency majorly? So I've given you some scenarios already. So let me throw some practical lights into what we want to talk about. So when I say I will teach you how to translate result and position into foreign currency, like this thought scope here. So when I say I want to teach you how to translate result and position, what I'm talking about here is this. So if a company trades overseas, that means it will buy and sell goods or assets in foreign currency. So for example, now, a Nigerian company might buy materials in US, so it will pay in dollars, right? So let's assume that he then sell those finished goods in Germany. So he will receive money in euro. So when that happens, so if it now happens that we are owing money at the end of the year in those foreign currency, right? Maybe or some people are owing us money, then those results, those positions, those assets, receivables and payables, how do you then translate them into your local currency, which is Naira? Because since your books will be shown in Naira, so that's what I mean. I will show you how to translate results and position into presentation currency. Another scope, which is this second one. I said, okay, how do you translate result position of a foreign operation? Okay, that you'd include in your financial statement either by consolidation or equity. So what I mean is that if you have a foreign operation like a subsidiary, okay, abroad, that is, you own a foreign entity, and you know that the subsidiary, let's say, is in London now, it will prepare its books in its own local currency. Okay. So when it does that, when we want to consolidate at the end of the year, when the parents want to consolidate that subsidiary, so somehow, so he would have to translate those assets and liabilities and profit of that subsidiary into Naira. We need to translate from euros or from pounds into Naira, one way or the other. So when it comes to translating result and position of a foreign operation, look at the proper exchange rate to use. But you see, if the exchange rates were constant, it is not something that changed, right? From the two scenarios I've actually shown you, whether from a foreign currency transaction or from a foreign operation, when you want to bring them into your books, if the exchange rates were constant, if it's the same, if it's 1,000 naira to a dollar all through the year, then I mean, there won't be any accounting problem if you are using the same exchange rate all through. But you agree with me that it's not stable, it changes, it fluctuates. I mean, the naira to dollar might be 1,000 naira to a dollar this month. In the next day, it could be 1 to a dollar. So it's something that fluctuates a lot. And like I've mentioned, so the exchange rate is the major issue here. And the fact that it fluctuates is not stable. Okay. So that is what we want to learn how to deal with. So some key terms you'll be meeting as we move along. One is presentation currency. So from the name is the currency in which financial statements are presented. Okay. So of course, I've been mentioning exchange rates. So it's the ratio of exchange for two currencies. Okay. Ratio of exchange for two currencies. And spot exchange rate is the exchange rate for immediate delivery or the exchange rate of that day, right? The transaction exchange rate or the transaction date exchange rate, that's the spot exchange rate. Then the closing rate, which is the spot rate at the end of it, right? The spot rate at the end of the year. So the spot exchange rate is the exchange rate on a transaction date. So closing rate is the spot exchange rate at the end of that year. So of course, I'm mentioning foreign currency. So is the currency that is not the functional currency. Of course, you don't know what functional currency is. So I will explain that later, very soon. So foreign currency is just the currency of another country. You can put it that way for now. So, but here the standard say that is a currency other than the functional currency. Then I've mentioned foreign operation. Okay, so foreign operation is an entity that is either a subsidiary, an associate, a joint arrangement, a branch of a reporting entity whose activities are conducted in a country or currency other than those of the reporting entity. So, I mean, it's just like a foreign branch, a foreign subsidiary. Of course, its activities are conducted in another currency that is different from your own because it is in another country. So its currency would definitely be different. So, and of course, you meet exchange difference, right? So see, the problem of fluctuation in exchange rates usually results in exchange difference in the sense that, so when you're translating a transaction and let's say the transaction happened in January, you translated it at one rate in January. Let's say you're now paying much later. You're paying much later. So at the date when you wanted to pay, the exchange rate has changed again. So there will be some differentials. That's exchange difference, okay? So exchange difference could either be an exchange loss or an exchange gain, right? So when you're translating from one currency to another currency using different exchange rates, there's no way your balance sheet will balance. There will be some gap because of those different exchange rates. That is an exchange difference, right? If you're looking at it from the angle of translating a foreign operation, if you are translating a balance sheet and you're not translating it at the same rate for all items, it will not jive. There will be an exchange difference, right? So if you're looking at it from a spot transaction that you consummated and you translated it to Naira, and the date of settlement is different from that day. And when you're settling, the exchange rate has now changed again. Things will not jive. Things will not jive. So you will see there will be some balances, which I will show you practically very soon. So that's exchange difference. So differences arising from translating from one currency to another using different exchange rates like that, or differences arising from fluctuations in exchange rates. I mean, I think you get the idea of what I'm talking about. Another one that you will hear me mention often is monetary items. So the similitude to what you have known before for monetary items will be financial assets. Okay. Financial assets. It's very similar to monetary items. So IAS 21 said that monetary item is cash. So is a unit of currency, cash held is a monetary. When you have unit of currency that you hold, is a monetary item. Majorly cash is a monetary item. And when you have assets or liabilities that you have to receive in the case of assets or pay in the case of liabilities in a fixed number, in a fixed or determinable number of units of currency. So you know how much, if you have an asset and you know how much you're going to use that you're expecting to collect in cash, that is a monetary item. That's you have an asset like a trade receivable now. Trade receivable is a monetary item because you know how much you're going to receive in cash. Or let's say you have some pension receivable or a pension payable. It's a monetary item because you know how much you're going to receive or pay in cash. Or you have lease liability. It's a monetary item because you know how much you're going to pay in cash. So monetary item is similar to financial assets and also financial liabilities. I mean, the key understanding about that you need to have about what a monetary item is the fact that one is cash, like a unit of currency that is held. Number two is that it could be an asset, and what you're receiving is fixed or determinable. You know how much. Say fixed or determinable, I'm talking about cash, money. Okay. If it's a liability, then you know that you must know how much you're paying in cash. Then that is monetary item. And I mean, that is what makes it different from non-monetary. So non-monetary will be items like PPE, intangible assets, repayments. Those are non-monetary in the sense that what you are expecting to receive, if it is an asset, varies. It's not fixed or determinable. It's not something you know in advance. You don't know. Just like provisions, for example, now, right? Provisions that you don't know how much you would set to. It's not fixed. So, or inventory that you want to sell. I mean, the prices varies. You might end up giving discounts, something like that. So those are non-monetary items. Their values are not fixed. What you would receive is not determinable. So monetary and non-monetary. So the way IAS 21 explains assets and liabilities to us is by classifying them into monetary and non-monetary, because that is the basis on which we are going to translate them eventually if they are in foreign currency, and we need to bring them into our books. So we classify those assets and liabilities into monetary and non-monetary. So do not forget this because is important for us in IAS 21. And another term here is net investment in foreign operation, which is the amount of interest in the net assets that we have in that operation or our holding in that foreign operation or our stake in that foreign subsidiary. So that's our net investment in a foreign operation. Another one is functional currency. You see, when IAS 21 was defining a foreign currency, he said it's a currency that is not the functional currency of the entity, right? That's a foreign currency. So we can easily guess, that, okay, so if you have a subsidiary, you consummated a transaction in Ghana. So of course, that transaction will be consummated in cedis. So that cedis is a foreign currency. So the standard says that, okay, so cedis, foreign currency, is a currency that is not the functional currency of the entity. So that means if the entity is resident in Nigeria, So that means, from that definition, you can guess that functional currency will be Naira. Okay. But the thing is that it might not be Naira. It might not be Naira. So then what is functional currency? If it might not be Naira, if it might not be the currency of the country in which you are resident, so which mostly it will be, but let's look at it together and see so that you understand what it means. So functional currency is the currency of the primary economic environment in which the entity operates, primary economic environment. So, and when we say primary economic environment, we are talking about the environment in which, of course, in which the entity makes money, right? The environment in which it makes money, that it generates and expends cash. So if you are resident in Nigeria, you're not making money or spending cash in Nigeria, that means Naira is not your functional currency. Okay. So basically is the currency of the primary economic environment, which is the environment where you generate and expense and you expense cash. So the determination of factors that we look at in determining functional currency, there are these two primary factors, which is the key one. Two. Number one is the currency that influences your sales price, which is the currency in which your sales price for your goods or services is denominated and settled, right? So the currency in which your sales price is denominated. So if you are selling perfumes, if your perfume on your store, on your online store, if it's denominated in dollars, that means dollars is your functional currency. So the currency that mainly influences sales price for goods or services, that mainly influences, fortunately now, it seems it's dollar that is influencing most of our sales prices in Nigeria. When dollar goes up, everything goes up. Dollar seems to be the functional currency in Nigeria now because it's influencing sales prices in Nigeria. But unfortunately, the issue now is that most of these sales prices are not denominated and settled in dollars. They are denominated and settled in Naira. So it's causing a lot of problem for us. So ultimately now, the functional currency still remain Naira because primarily we would expect in a normal environment that the price or the currency in which your sales price is denominated or settled should be what would influence your sales price. Unfortunately, yeah. So the second one is that the currency of the country whose competitive forces and regulations determines your sales price. Competitive forces and regulation mainly determine the sales. So that's the currency of that country is mostly your functional currency. So these two are the primary factor. And you see that everything revolves around your selling price, selling price. So the first one is that, okay, the currency in which your selling price is denominated and settled. The second one is that the currency of the country whose competitive forces and regulation mainly determine the selling price of your goods or services. So those are the primary factors. So if I can should ask you, what they want you to mention are the primary factors. However, they could be secondary. So if this is not apparent, if this does not solve our problem, which we expect we should, so we could look at some other factors like the currency in which funds from financing activities are generated. So if you have to raise capital, whether you're using debt or equity, so the currency in which you receive those money. Okay, like in Nigeria now, you find out that most of these startups, most of them raise money in dollars, right? So if these are not quite apparent, then if you have to use the secondary factors, then that would be their is the currency in which they raise money. okay, the currency in which funds from financing activities are generated, and then that would be their functional currency. Then another one is the currency in which receipts from operating activities are retained. So even though if you're making naira, but you're converting everything to dollars, probably because, I mean, the only reason why you will retain that is probably because most of your goods, you need to restock them in dollars. And that's the only reason why you would. So we expect that it's the primary economic environment that you would operate that would expect you to retain the receipts from your operating activities. So the currency in which receipts from operating activities are retained, that is your functional currency. So we have discussed the primary factors and the secondary factors. Now that you know what a functional currency is, which is the currency of the primary economic environment in which an entity operates, then we need to be able to determine whether a parent and a subsidiary have the same functional currency or not. Don't forget, a parent and its foreign subsidiary, they are not in the same currency. They are not in the same country, right? But they can have the same functional currency. I mean, functional currency is the currency of the primary economic environment in which an entity operates. The currency that determines or in which your selling price is denominated and settled, or whose competitive forces and regulation determines your selling price. So a parent and its foreign operation have the same functional currency. If that foreign operation is carried out as an extension of the parent, for example, now, where the foreign operation only sells goods imported from the parent and remits the proceeds to it. It only sells goods. So that means that if the foreign operation is in London and it only sells goods that it's imported from Nigeria, and as soon as it makes the money, that receipt from that operating activities is immediately retained in naira because it has to remit it to the parents. So that means he's operating as an extension. It's just an extension. It's just like it's the parent entity there, right? So in that case, there's high likelihood that they have the same functional currency. Number two, if the transaction of the foreign operation with the parent entity, if they are in high proportion, or majorly they consummate transactions among themselves. All transactions, whether selling, purchasing, everything that the foreign entity does is from the parent entity. So they will most likely have the same foreign functional currency. Another one is if the cash flows from the activities of the foreign operation directly affect the cash flows of the parent entity and are readily available for remittance to it. So this is similar to that first one. So, if all the money that the foreign operation makes, it remits it to the parent entity. So that means their cash flow impact on one another. So, and it's readily available for remittance to the parent. They have the same functional currency. That means they are impacted by the same economic environment, right? So another one is that if funds must be provided by the parents to enable the foreign operation settle its debts, they have the same functional currency. Okay. So that's the first thing I need you to note here, this definition. So just to be sure that you're following, it's been long I did this. So let's just see. Let's look at this quiz together. So it says the functional currency of a foreign subsidiary is most likely to be its local currency. The functional currency of a foreign subsidiary is most likely to be its local currency if the subsidiary is acting as an intermediate if the subsidiary operation are interdependent with those of the parent, the subsidiary operates independently, if there's high interrelationship between sales and local currency and the currency of the parent. What's the answer here?
Independently.
Sorry?
Independently. That is,
That's
subsidiary is working independent of the parent. So
that's
can
correct.
adopt the local currency.
That's correct. That's correct. So that means it doesn't have the same functional currency as that of the parent. Good. Let's look at the second one. Which of the following is a primary factor in relation to determination of functional currency? Currency in which funds from financing activities are generated, currency in which sales prices are denominated, whether transactions with the parent are in high proportion, currency in which receipts from operating activities are retained. What's the answer here? Which of the following is a primary factor? I gave you two primary factors. Number one is that the currency in which sales prices, the currency that
It's B.
mainly sales prices. Oh, sorry, what did you say?
So when you were explaining, it's B. You explained for
Mm.
primary, they had to do with sales. Either
Yes,
the sales settled or the
denominated.
economic environments that affect the sales. So both of them are sales. So it's B.
Yeah, that's correct. Is B. So number three, monetary items are best described as plant and equipment, unit of currency held, asset and liabilities received or paid in fixed number of currency, tangible. What's the answer here?
B.
B. This one
That's
is B.
correct.
This one is obvious. It's B.
Yeah, correct. So, okay, so that means you understood everything I've mentioned so far. Good. Good. Okay, so let me summarize what this standard deals with. So I've mentioned it before. So the way foreign currency transaction works is this, okay? So when an entity is preparing its financial statements, right? So that entity first must determine its functional currency, because all foreign currency items must be translated first into the entity's functional currency. So functional currency is extremely important, extremely, because as an entity, when you carry out foreign currency transactions, you need to you need to translate those foreign currency transactions into your functional currency. Functional currency first. That is clear. I hope that's clear. That's the first thing. The second part is this. When you have a foreign operations, Mr. Kazim will teach you foreign subsidiary. So the knowledge you are getting from here is exactly what he's going to be teaching you. You just had one or two things because of consolidation. I am not teaching you consolidation. I'm focusing on how do you translate. So when you have a foreign subsidiary, foreign associate, foreign branch, that parent must translate their financial statements into the currency in which the parent prepares its financial statement. So Mr. Kazim would really focus on consolidation, and of course, he will also deal with some translations as well, but you will have learned it from here as well, because all that is a take from IAS 21, right? So the third is this. Now, where presentation currency, where it differs from functional currency, then financial statements must be translated into presentation currency, right? So if you have a scenario where your functional, which is not likely in 99.9% of cases, functional currency would always be the same as presentation. But I mean, you could decide presentation, and you can present your financial statements in any currency you wish. Your primary economic environment might be Nigeria, and you decide to present your financial statement in in euros. Just make sure you don't submit that financial statement to FIRS or any regulator in Nigeria. They will throw it back at you. In as much as it's just for your internal use, your policy within your organization, that okay, this is how you want to present your financial statement. This is the currency you want to use, then fine, it's okay. So that is more superior than functional currency. It becomes more superior, even though initially it's functional currency that you need to translate all foreign currency items into. So at the end of the day now, when you now want to present your financial statement, then they are not the same. Just use presentation currency. So, and that's why I need to ask you this question. So they say that in order for financial statements of a foreign operation to be included in the consolidated financial statement of the parent, okay, it is necessary to translate that foreign operation financial statement into what is the presentation currency of the reporting entity, functional currency of the foreign operation, local currency of the foreign operation, domestic currency of the foreign operation. Which one are you translating it into?
Presentation currency.
Presentation.
That's correct. So you get the idea now. So presentation currency is ultimate. Is ultimate. That's the currency in which you present your financial statement. It's presentation currency. Okay, but the only thing I've mentioned is this. When you consummate a transaction, maybe you buy goods, you sell goods, you borrow money, you lend somebody money in foreign currency, right? So when you're translating it, you translate it into your books in your functional currency. That's the requirement. Okay. So ultimately, when you are then presenting your account, your financial statement at the end of the year, then we start talking about presentation. In most cases, should be this functional currency, except if you decide otherwise. So now, let's now go to the basics. So foreign currency transactions. Foreign currency transactions. So that would be my focus majorly for tonight. Not more on foreign operations, even though I'll mention a few things around that as well. But I'm going to focus more on when you consummate transactions in foreign currency, which are transactions that is denominated or that you have to settle in foreign currency, like you bought goods and I mean, those prices are denominated in foreign currency. So, or you borrow or lend somebody money, and those money are payable or receivable in foreign currency. Or you bought or sold assets, and they are denominated in foreign currency. Any transaction, or you have to pay salaries, and they are denominated in foreign currency. That is a foreign currency transaction. When a Nigerian company, I have to use Nigeria because that's where we are right now. When you consummate transactions in other currencies, when you consummate transaction in another country, then that is a foreign currency transaction. So how do you recognize such in your books? So the fact that it's a foreign currency transaction, that means it's the currency of the transaction would definitely be different from your functional currency. So those foreign currency would be initially recognized in your functional currency. I've mentioned this before. So, the standard is re-emphasizing it again, that foreign currency transaction shall be recorded on initial recognition in the functional currency by applying the foreign by applying by applying to the foreign currency amount the spot exchange rates between the functional currency and the foreign currency at the date of the transaction. So, of course, at the date of the transaction, the exchange rate of that date is what we call spot exchange rate at the date of the transaction. So, you are going to translate, you are going to convert that foreign currency into your functional currency using the spot exchange rate. So, if you buy machinery in US today, so today, as soon as you have bought it and the person have transferred control, whether you have gotten delivery, but at least you have bought it. So that transaction, when you are putting it in your books, you put it by translating. If it's $10,000 now that you bought it, you need to translate that or convert that $10,000 to Naira by using the exchange rate today. At the date you are recognizing it in your books, that is what we call spot exchange rates. That's initial recognition. Okay, Blessing, you can go ahead, please.
Yes, I have a question.
Okay.
Yeah, you talked about presentation currency and functional currency. Assuming for tax purposes, the local business, you have a foreign subsidiary, or you are a parent of a foreign subsidiary, right? And the foreign subsidiary translates his self in their functional currency. Then in terms of tax purposes, let's say in Nigeria, that happens to be the parent company, how will you how do you recognize how do you present your what do you call it? How will you present it to the tax authority? Will you use the presentation currency or the functional currency?
The presentation currency.
The presentation.
Because that's currency you'll have to pay your account. I didn't know that was the direction your question was going. I was expecting that you were going to say that would the foreign operation pay tax in Nigeria? That was what I was expecting your question to direct to, but since it's not directed to that, so I think I've answered your question, right? It will be presented in its presentation currency. However,
that's not in Naira.
Definitely. So, and that question, to clarify it better to you, you see, so taxes is entity by entity. Okay. So the parents would go to FRS separately. The subsidiary will go to FRS separately. FRS doesn't care about your group accounts. Is entity by entity. So of course, the foreign operation will really have no serious business with FRS because they're not making money in Nigeria. So they would have paid tax in the country in which they are making money. But that would not really be an issue for them, except if they are consummating transactions in Nigeria. So withholding taxes will come in, which might be the final tax, and a lot of other issues. So, I mean, we call them non-resident entities. Okay, so let's move on. We have quite a lot to do tonight. Okay, so that's initially when you consummate those transactions. So at the end of the year, now, if you now have either assets, I mean, maybe you have receivables, maybe you're still owing money, you have payables in foreign currency, then how do you then include that in your books? Because you need to present your accounts and you have consummated some transactions in dollars and you are still owing like $20,000 at the end of the year. So how do you then translate that into Naira? So monetary items, foreign currency monetary items will be translated using the closing rates. Foreign currency monetary items shall be translated in using the closing rates. Non-monetary items, they are usually measured at historical costs. Non-monetary items that are measured at historical costs, okay, in the foreign currency. So we'll translate them using the exchange rate at the date of the transaction. So when you want to translate non-monetary items at the end of the year, like PPE, like intangible assets, like inventory, you are going to translate them using the exchange rate at the date of the transaction. At the date of the transaction. So at the date the transaction was consummated. So you're going to use an historical rate for non-monetary items that are measured at historical cost. You know that there are mostly a lot of these non-monetary items are also measured at fair value. In that case now, you're going to translate them into your presentation currency using the exchange rate at the day the fair value was measured. Okay, you're going to translate them at the day the fair value was measured. So, I mean, these three you need to know. When you're doing foreign subsidiary, you would use it, definitely. You would definitely use it. So, there, they would be talking about how you're going to translate share capital, how you're going to translate pre-acquisition retained earnings, how you're going to translate post-acquisition retained earnings, and yeah, those ones like that. You need to arrive at that. So more information will be given to you that, but it's not a difficult part. But what we need for would be monetary items. So for monetary items, you translate them using closing rates. And I've given you an example of monetary items, trade receivables, payables, or any asset or liabilities that you are going to receive or pay in a fixed or determinable unit of currency. But non-monetary items like PP, intangible assets, inventories, provisions that are measured at historical costs, you are going to measure them using the rates at the date of the transaction. But the one that are measured at fair value, you're going to measure them at the rates at the date where the fair value was measured. Okay, so that is that. Now, so usually at the end of the year, when you are using different exchange rates, the two exchange rates I've mentioned here are closing rates and historical rates, right? When you are using different exchange rates, like I've explained before, it usually results in exchange differences, which is exchange gain or losses. So when you have such, the standard says that if the exchange difference is arising on settlement of monetary items, okay, if it's as a result of translating monetary items, then we're going to recognize that exchange difference in P&L. We're going to recognize it in P&L. So, I mean, and they talked about some other things here, but it's better with a question. So let's go practical. All of these things I've mentioned. Now I want to solve questions. What time is it now? 9:20. Okay, you're mostly going to finish this class around 10:30 today. So you just have to hang on because I have like 4 questions to solve. So the first one here is talking about a Nigerian company that buys a large consignment of goods from a supplier in US. So the order is placed on 1st May, and the agreed price is $124,000, $124,250. At the time of delivery, the rate of exchange was 3.5 to 1 naira. And as at 30th June, the Nigerian company said to the supplier when the exchange rate was 3 naira 55 cent to 1 naira required. How would the local company record this transaction in its books? Okay, so at the date of the transaction first, where you would initially measure this foreign currency transaction, which is May, the exchange rate at that date was 3.5. So, and I told you, you are going to translate or convert this at the rates existing at that date, at the date of the transaction. So at that date, debit the assets by converting that dollars to naira. So since it's 3 to 1 naira, so you multiply the purchase price by the exchange rate. So this is the amount you record in your books. 434,000.
Excuse me.
Yes.
It appears that the intention was to write 3 naira 50 kobo to $1. It appears that was the intention.
Yes.
The other way around, yeah.
Yes, I agree. Because it's dollars that should have more value. It's dollars that should have more value, which is why we are multiplying it together. So this is the naira value, which is this. Then you credit your trade payables with this. You credit your trade payables with this. So that's at the date of the transaction. But apparently we did not settle at that date. We settled much later, which is June. So we settled when the exchange rate was, we did this one very well. Okay, I mean, I just changed it, $1 to 3 naira 55 kobo. So at that date now, that means what we are going to be paying is 124. By the time we multiply by 3, this thing, we'll have to go and look for 441,000 naira. Okay. As against, when we translated it at the beginning, it was 434. So, which is good for us because as far as we are concerned now, we are going to debit our payables by the balance in that payables account. Okay. Then we'll credit bank with whatever it is that we have paid. So this one now would then debit loss on conversion to P&L because we are making a loss in this case. Because ordinarily, if you had what we were owing was just 434, but because of these exchange rates, it moved against us. What we had to pay was even more than what it was before, which is the problem we're having in Nigeria now. The exchange rates keep getting worse and worse and worse. It keeps depreciating, naira keeps depreciating. So things are getting more expensive. So this guy now, he would have, if he had paid in May, he would have paid 434,000. But because he didn't pay, he waited for some months. He's paying 441 as against 434. So unfortunately for him, he has incurred a loss. He has incurred a loss of 6,212.5. So we debit our trade payables, we debit P&L, and we credit bank. So this exchange, this loss on conversion is what I was referring to as exchange difference. This is what I was referring to as exchange difference. So this guy has made a loss. So however you want to present this in the exam, you need to understand that this guy is making a loss. He's paying much more than what it was in his books when he consummated this transaction. And that's the definition given earlier on by as exchange difference. When there is different exchange rates from the date of transaction to the date of settlement there will be differences. So in this case, it's a loss because we are paying more. Okay, let's look at another one. Edo PLC, his year end is December. He bought some goods from Ronicare in US on September. So the invoice value was 40,000, and it's due for settlement in equal installment on 30th November and 31st January. The exchange rate moved as follows. So exchange rate from dollar to 1 naira. So $1.6 to 1 naira. I hope so. 1.8 to 1 naira. I hope so. 1.9, 1.85. So in this case now, dollar is more like naira is powerful than the dollar. So and that's why you should show the accounting entries. So similar to what we did earlier on, this guy bought goods in September worth 40,000. So the first thing we need to do now at the date of the transaction on 30th September is to translate or convert that goods into naira. So you debit purchases since naira has more value. So 40,000 divided by 1.6. So $40,000 is just 25,000 naira. Then you credit your trade payables with 25,000. Okay, that's the first thing we do. Then being purchases on credit. Going back to the question, they said is due for settlement in equal installments. In equal installments in November and January. Okay, equal installments. And they ask us to show the accounting entry. So that means that the first installment is due in November. So as of November, since the amount we are owing is $40,000, so that means we have to look for $20,000 and give to that guy. And so that means we will need a naira worth of, because the exchange rate as of November, if you look at it, was 1 naira 80 kobo. I say 1 naira 80 kobo. $1.80 to a naira. If you need to raise half of what we're since we need to pay that foreign supplier in equal installments, so 20 in November, 20 in January. So we will need to raise 11,111 naira. So which is $20,000 divided by the exchange rate at that date of settlement. So in this case now, you will see that we have made a gain. We have made a gain here because ordinarily, at the date where we bought this item, we recognize 25 naira, 25,000, and half of that should be 12,500. That's half of that. But now we are settling for just 11,000. So we are making a gain of 1,389. Okay. So because the requirement is that we must settle in equal installments. So we'll debit in naira, we'll debit our payables by half. Because what is in our payable is 25,000. So we debit half. Then, of course, we know that we have made a gain of 1,389 and we paid 11,101 naira. Okay, so as far as we are concerned, in our trade payables account, what will be there as balance will be 12,005. What will be there as balance is 12,500. This exchange gain will go to POL and credit our cash account with how much we are actually paying. Because we are paying 11,111. So that is in November. Now, the second settlement is happening in January. But before the second settlement, the year end of the company is in December. Okay, so at the year end, remember the company will have to prepare its accounts. So, and as far as we are concerned, we have a foreign currency payables of $20,000 because we have only paid half to this guy. So at the year end, that remaining half, we need to translate it. We need to reposition it. We need to know how much is it. And the law I told you is that you translate it at the closing rate. So that $20,000, we translate it at 1.9. So as at December, that 20,000 that we are owing, you translate it to Naira, is just 10,526. And how much will be in our receivable? Sorry, I say receivables. How much will be in our payables balance? It's 12,005 because we have really debited it with 12,005, half. So the remaining half of 12,500 will be there. But unfortunately, fortunately for us, the exchange rate favored us. So we only need to raise 10,526 as against 12,005. So we have made a further gain again of 1,974. So all you just need to do is to update our payables from this 12,500 to this balance at the end by debiting the payables by that gain. Okay, when you debit it with that gain, it will bring it down from 12,500 to 10,526, and you credit your exchange gain. So we have made two gains now as at the end. One was at the date of the first settlement, we made a gain that we put to P&L of 1,389, and we made another gain at the end. So we have made a total gain of around 3,363. Okay, that's that at the end. Now, on final settlements, as 31st January, we would pay the second installment. And this second installment, the rate is $1.85 to a Naira. So by the time we convert that remaining 20,000, we have 10,811. Don't forget what was on our trade, on our payable balance is now 10,526 as at the end. But now we have to go and raise 10,811. It becomes a loss. So first, since the balance here is 10,526, so we debit trade payables by that. The loss goes to POL, Credit Bank, with 10,811 cash. And that's it. Okay, now let's solve past questions to strengthen our understanding before we trickle down to last diet question. So this one was a deep IFR question, 2015. It says on 1st August 2015, Delta purchased machine from a supplier located in a country whose local currency is the GOAT. The agreed purchase price was 600,000 GOAT payable on 31st October 2015. The asset modified to suit Delta's purposes at the cost of $30,000 during August 2015 and brought into use on 1st September 2015. The directors of Delta estimated that the useful economic life of the machine from the date of first use was 5 years. Relevant exchange rates were as follows. So they gave us all that, all figures assumed correct, required. Explain and show how the event would be reported in the financial statement of Delta for the year ended 30th September 2015. Okay. So let's solve this. So now the transaction date was 1st of August. And we purchase machine from a country that uses goods. So we paid 600, the purchase price was 600,000 goods. And we are supposed to pay in October. But the transaction was consummated in August. So that's that first. So we modified the assets. We incurred 30,000 during August. Started using the assets in September. So the useful life of the asset is 5. Okay, good. Firstly, that means our functional currency is dollars as far as this is concerned, since this told us the currency of the country is good and they are telling us 2.5 to $1 and all of that. So our currency here is dollars now. So at the date of the transaction, we need to translate or convert this 600 to dollars using these rates. So dollar is powerful. So we need to divide 600 by 2.5. So the asset will be recognized at this. So we debit the asset to credit payables since we are not paying on that date. So 240 will be there. Now, when October comes, hold on. October, okay. Our year end is September. So that means we need to translate we need to prepare our account as at the year end. So, and that's all they are even asking. This one is straightforward. So that means as at September, our trade payables will need to be adjusted because as of September, the exchange rates, we're going to translate this at, I'm going to translate it at the closing rate. So we would update our trade payables from 240 that was there before. We're going to translate it to 2 naira, which is the closing rate. So our trade payables becomes 300, which is not good for us. So that means we have to pay more in dollar terms. So we are making a loss of 60,000. So that loss, made a mistake here. That loss, we're going to debit the exchange loss in P&L by 60. And we're going to credit trade payables by 60. So that will bring up the trade payables from 240 to 300. So we're making a loss. And that is it. But as far as the asset is concerned, we don't have to change this 240 because I told you non-monetary item that is measured at historical cost will be translated at the historical rates. So it's still these rates that will still be applicable at the end. So this 240 for assets remains 240. So, but because we incurred modification cost of 30,000, that will be capitalized because it's a directly attributable cost. That will bring our total cost to 270, right? And because they told us the useful life of the assets, so that means we need to depreciate it when we started using it, when we received it, we will depreciate it over 5 years. So which will give us, since our year end is 30 September, to be 270 divided by 5, then we prorate it. Since it was put into use in September, it was available for use in September. So that's just 1 month. So we prorate it by 1/12. So our depreciation is 45. That means the carrying amount of the machine is 270 minus 45, which is 265,000 as at the year end. So we stop at that because that's what the question required. So if we were to, let's assume they also ask us to continue. since we're settling in October, so that means that the exchange rate is now 6.21. So which makes the dollar weaker, no, stronger. It was 2.0. Now it is 2.1. Is this weaker or stronger? It's not stronger. So by the time you do 600 over 2.1, can you press your calculator? Or what would that give? Okay, if you do 600 over 2.1, what would that give you? Anybody with calculator there?
285,714.
Okay, so dollar is stronger. So because as at the year end, it was 300, we were thinking we would settle, but now it's 285, we're going to settle it. So it's good for us. We're making an exchange gain of around 15,000 approximately. So that means you will just debit your payables with this, then you credit your cash with 285, then you credit exchange gain with that 15,000. But they didn't ask us to do that, so we move forward. Another question. I want to believe the reason why nobody is saying a word is because you understood everything, you understand everything. I want to assume that. So the second one, they said on April 2018, Epsilon accepted delivery of a large and complex machine from overseas supplier. The agreed purchase price for the machine was 20 million, which is the functional currency of the supplier. Under the terms of the agreement with the supplier, 12.6 was payable in July, with the balance of 7.4 being payable in November. The payment due on 31st July 2018 was made in accordance with the terms of the agreement. Epsilon does not hedge, so incur direct costs ready for use in April. Incur additional costs on training. Estimate the machine will be used until I have no residual value. Okay. Explain and show appropriate calculations how the above events should be reported in the financial statement of Epsilon for the year ended this. And they gave us the exchange rate. Okay, I think we should look at this one. It's just the same thing as the first one. So it's the same thing as the first one. There's no so much difference, coupled with the fact that the solution is here. So let's go to last direct question. So before I go to last direct question, any questions before we move to ICANN last direct? Okay, if there are no questions, can somebody read for us? I need someone to read.
Calabar Nigeria PLC, a company located in Ajao Industrial Estate, Lagos. The company specializes in the production of Adire t-shirts. The company has a number of subsidiaries located in the south and southwest regions of the country and overseas. On October 1st, 2022, Calabar PLC acquired 100% of the ordinary shares of Mansak Concor Limited, an Adire t-shirts distribution company based in the Gambia, West Africa. The official national currency of the Gambia is known as Gambia Dalasi, GMD. The draft statement of financial position of Mansa Concor Limited, prepared under Gambia General Acceptable GAAP as at 30th September 2023, is as follows. Additional information. The following are key transactions of Mansa Concor Limited under Gambia GAAP. There is no deferred tax under the Gambia GAAP equipment 1. Equipment. On January 1, 2023, Mansa Cooper Limited acquired some specialist equipment from the United States of America for $150 million. Payment for the equipment was made on 31st March 2023. In accordance with the local Gambia GAAP, the cost of the equipment was recognized on January 1, 2023 at GMD 50 million, using the opening rates of exchange at October 1, 2022. Full year's depreciation of GMD 5 million was charged to cost of sales as Mansa Cooper Limited depreciates the equipment over a 10-year life, and it has no residual value. Hence, the equipment was included in the statement of financial position of Mansa Cooper Limited at GMD 45 million. The sum of GMD 12.5 million has been debited to retained earnings. This is in respect of the difference between the amounts paid to the supplier of GMD 62.5 million on March 31st, 2023, and the cost recorded in non-current assets of GMD 50 million. 2. Impairments. Mansa Cooper Limited bought a warehouse on October 1st, 2016 for GMD 180 million, and the warehouse is being depreciated over 20 years with no residual value. On October 1, 2022, due to a rise in property prices, the warehouse was revalued to GMD 210 million, and the revaluation surplus of 84 million was recognized. No transfers are made between the revaluation surplus and retained earnings under Gambia GAAP is in respect of depreciation. However, there has been a slump in the local property market in Gambia recently, so an impairment review was undertaken at September 30, 2023, and the warehouse was assessed as being worth 60 million. Therefore, a charge of 90 million was made to profit or loss to reflect the difference between the carrying amount of the warehouse of 150 million before September 30, 2023, and a new value of 60 million. 3. Financial instruments. On April 1, 2023, Mansa Cooper Limited bought 5 million shares in a local quoted company for GMD 7.7 per share. This represents a 3% shareholding. The intention of the company is to hold the shares until December 31st, 2023, and then sell them for a profit. The shares have been recognized at cost in the statement of financial position in accordance with Gambia GAAP. The market value of the shares at September 30, 2023 was 12.5 GMD per share. Under the Gambia tax rules, income tax is charged at 20% on accounting profits recognized on the sale of the investments. Or provisions. On October 1, 2022, Mansa Cooper Limited signed an agreement with the Gambian government for exclusive rights for the next 20 years to supply Adire t-shirts for Gambia's National Traditional Festival, GNTF. The cost of buying these rights was 42.5 million GMD, which had been recognized as intangible assets in the Mansa Cooper Limited Statement of Financial Position. Under the terms of the right of agreement, Mansa Cooper Limited has to replace all damaged t-shirts at the end of the 20-year period. There is a 40% probability that the eventual cost of replacement of the damaged t-shirts will be 75 million GMD, and a 60% probability of the cost of replacement being 50 million GMD. However, for prudence's sake, a provision of 75 million GMD was made in the financial statements and debited to the operating cost of the company. Mansa Cocoa Limited has a pre-tax discount rate of 8%. The replacement cost will be allowed for tax purpose when paid. The relevant income tax rate is expected to remain at 20%. 5. The exchange rate for October 1, 2022 was $3. At January 1, 2023, 2.5. And March 31st, 2023, 2.4. September 30, 2023, $2. Notes: in Gambia, the tax treatment of property, plants, and equipment and exchange difference is the same as we have under IFRS treatments. The following are the exchange rates between Gambia dollar CGMD and Nigeria Naira. October 1, 2022, 4.2 GMD equals 1 Naira, and as follows. Required: as the financial controller of Calabar Nigeria PLC, draft a report addressed to the finance director of your company, explaining any adjustments which needs to be made to ensure that the subsidiaries company, Mansa Cocoa Limited, financial statements comply with IFRS requirements. B. Prepare a revised statement of financial position for Mansa Cocoa Limited that will be suitable for the consolidation with the parent Calabar PLC's financial statements as at September 30, 2023, in accordance with IFRS. Note: show all workings.
So
It's a
thank you.
loaded question. Almost 6 or 7 standards here.
Yes.
It's loaded.
Yeah. So thank you very much, Amy, for that. So this was the question 1 of last diet, and I think I've been telling you this, that and I've also informed Mr. Kazim to prepare you for this as well. So the direction of the question has changed, and mostly the A part of the compulsory would be that you need to make some adjustments, some IFRS adjustments to either the subsidiary or the parent. Then the B part might be okay. After you have not made that adjustment, then consolidate. So, which was similar to what we have here. The A part, which is the major part, of course, the performance of the student was very poor, because all of them were just expecting lawyer consolidates. But I think over the last 2 or 3 diets, ICANN has been telling us that, okay, it's not just about lawyer consolidate, it's beyond that. It's beyond calculating goodwill, consolidated retained earnings, and NCI, and doing some and canceling out intra-group transactions. They'll ask you very little of that now, right? They would ask you much more of how do you prepare accounts of either the subsidiary or the parent to comply first with IFRS, which is what this question is more about than group account itself. It's just the B part that, okay, oh yeah, translate. So in the exam, in all of your questions, the go-to part is not to start reading the question. Don't make that mistake in the exam. Don't just jump and start reading the question. No. The first thing you should do is the requirement. At least from reading the requirement first. One thing I know very clearly here is this, that I am the financial controller. So they want me to write a report to the financial director. And I know that they want me to write a report. So that one is important, because that will, out of this 18, I know that even if it's report alone, I just give them with that reporting template and I do nothing, I will get at least 2 marks. That body, that structure. So draft a report. So I would know that first. So, and they will say, explain. Don't start calculating. Zero. They said, explain. Explain. So you need to explain to them So explain adjustments that need to be made to ensure that the subsidiary, which is Mansa, comply with IFRS. Okay, so that is clear first. So let's quickly address that first. So from what Gbemi has read, you know that Mansa is a subsidiary of Calabar, fully owned. And you also know that Mansa is in Gambia. Mansa is in Gambia. So, and the official currency of Gambia is GMD. So they give us the statement of financial position of Mansa under Gambian GAAP. So that means Mansa doesn't use IFRS. It does not use IFRS. He has prepared these figures using Gambian GAAP. So, and that's why the question is asking for IFRS adjustments. So that this Gambia, it's like we are taking it from Gambian GAAP to IFRS. And they give us few very simple items that we need to quickly adjust for. So the first one was equipment, which they told us that on January, which is not the beginning of the year. January is not the beginning of the year because the end of the year of Mansa is September. So this January is just within the year. So that Mansa acquired equipment from US for $150 million, and is not paying until March. Okay, so at least this one is part of what I taught you today. That's the first one. So in accordance with Gambia GAAP, so the cost of equipment was recognized on January 1st, 2023 at 50 GMD using the opening rates at the beginning of the year. They said full year depreciation was charged to cost of sales, and this guy depreciates the asset over 10 years. It has no residual value. So the equipment was included at 45 million, which is 50 million minus the depreciation. So 45 is the carrying amount. So 12.5 has been debited to retained earnings in respect of the difference between, that's exchange difference between the amount paid in March, 62.5, and the cost recorded, 50 million. So they recognize an exchange difference. Okay, so that's what, let's focus on this equipment first and resolve it. So what were the mistakes that he made here that's against the IFRS? So this one is nothing here because this one is just giving us information that he bought the asset in January and he's supposed to pay in March. So these adjustments he made. So the guy, this $150 million, he translated it to their currency using the opening rate, which is the rate at the beginning of the year. And if you check it, what's the rate at the beginning of the year? That's $3 to 1 GMD. So that's 150 divided by 3, because their currency is actually more powerful than the dollar, as it should be. Most of our currency should be, African countries should be powerful than these European countries because of the resources we have. Unfortunately, it's the other way around. So $150 divided by 3, that this guy got 50 million. So what is wrong with what he did here? Anybody? What is wrong with what he did here? Anybody?
I think, just thinking aloud, first is to separate monetary from non-monetary items, because the rates to use for monetary and the non-monetary, depending on the dates, are different. Since it's an equipment, the rate you should use to translate should be the rate, the exchange rate at the point where that acquisition took place. So
Which
what we
is
have
which?
here is, okay, I said something.
I said, which is which date? Which date is that? You said at the date where transaction took place. Which date?
Okay, I'm trying to go up to see
That would be January.
January. Yeah,
That would be January.
January 1st, 2023.
Yes. Okay.
January 1st, 2023. So the
yes.
exchange rate you should use based on what we learned about the standard for non-monetary item should be this rate, $2.50, not $3.
Okay, that's correct.
I thought it's going to be on a historical cost because you said the non-monetary.
This is the historical cost.
Okay.
This is the historical cost, $2.50.
Yeah. So when you consume it, according to IS 21, what we learned today, when you enter into foreign currency transaction, it is initially recognized at your functional currency at the date of the transaction. So that's always the case, is just get the rate at that date. So it is at the end of the year that you can now be, so Robert, the issue of separating whether it's monetary or non-monetary is of no relevance at the beginning of the year. So it is at the end of the year you start looking at, okay, which one is non-monetary, which is monetary, then you start doing your. But when you consummate the transaction, all transactions, all is initially recognized at the rate at that date, at the spot exchange rate.
Okay.
At the spot exchange rate. So that's what is wrong with this. So this 50 million is wrong. We need to correct it. And if you look at the way I presented my solution, I did it in a report format from financial controller to the financial director, subject adjustment to ensure Mansa Konko Limited financial statement comply with IFRS requirements. And you can also put the dates. Then I started. The subject matter refers. The following are the adjustments required to ensure Mansa Konko Limited financial statement comply with IFRS requirements. Equipment. I said 1. According to IS 21, non-monetary assets are translated at the exchange rate at the transaction date. So the amount to be recognized is $150 million divided by 2.5, which is GMD 60 million. So the company's figure will be updated with the journal below. You know that they recognize 50. So, but it should be 60. So I will debit the equipment with 10 and I'll credit payables with 10. Because they have not paid. It's not like they paid. They told us they won't pay until March. So I will debit equipment with 10. I will credit payables with 10. Just so that I increase the two. So I've bought it. So being update required to update wrong transactions or wrong amounts. Let me call it wrong amounts. So that was the first correction I made there. So of course, if you go back to the question, it will affect the second part, which is the depreciation they calculated. And this guy, they did full year depreciation, which is wrong. This asset was acquired during the year, so they need to prorate. So they gave us the useful life 10 years. So that means this 5 million depreciation is wrong. So, and this carrying amount is wrong. So I corrected that also. I said 2. Depreciation should therefore be 60 divided by 10, multiplied by 9/12.
For the 9 months, okay.
For 9 months, from 1st January to September.
Till September.
So that gives me 4.5. And I said the following journal will be passed to update to the correct figures. So because those guys recorded 5 million. So I need to pass a reverse entry by bringing that 5 million to 4.5. So I credited depreciation because they said it goes to cost of sales with 0.5 to bring it from, ordinarily depreciation should be debited ordinarily. So since I want to reduce it, I credit it. That's the major essence why I'm crediting this depreciation. And I now debited accumulated depreciation with 0.5. Ordinarily accumulated depreciation should be credited. But because I intentionally want to bring down their figures from 5 million to my own 4.5, that's why I'm debiting this. So the reverse. So being decrease in depreciation charged. So from our adjustment now, the carrying amount of the assets would therefore be 60 million minus 4.5. So if you punch your calculator, that will give us 55.5. That's now the carrying amount of this equipment. Is that clear? Yes, it is. So let's go back to the question. So I've corrected this depreciation. Now, the third one. So this guy booked a 12.5 million exchange loss because they say it has been debited to retained earnings, right? Okay. Even though it should go to P&L, because exchange loss should be to P&L. This exchange loss is not from that asset, it's actually from the payables because these assets, as it is now, is measured at historical cost. So at the year end, we are not going to use, we're still going to use the rates at the historical rate. So the figure will not change. It's the 60 million that we translated it to still remain, but the payables, which is a monetary item, will be updated. So this loss now was as a result of the payables, right? And they said that this is in respect of difference between the amount paid to the supplier of 62.5. And how did they get this 62.5? How did they get this? And I think, how did they get this 62.5? And the amount of cost recorded of 50 million. I think they got this is 2.5 by doing, can somebody do 150 divided by, where is the exchange rate in October? Maybe in March. Can somebody do 150 divided by 2.4? Let's see. I just want to check out the got that is 2.5.
Yes, correct.
Yeah,
62.5.
Okay, good. Okay, good. So that was how they got this is 2.5, which is okay. Which is okay. According to IFRS 2, is the same. The difference we'll have is the fact that the payables that we recorded is not 50 million, it was 60 million because of the mistake they made here. So we will not have the same exchange loss. We'll be having different loss. So this is how I corrected it. So I said number 3. I said the difference between the amount, the difference between the amount paid of 62.5 and the costs of the asset of 60 is 2.5. So adjustment required is as follows. So what I did is that I debited my trade payables with 10 because then I credited my exchange loss. Since I don't have my P&L items here, I just use retained earnings, but I know it goes to P&L with 10. So why did I do this? Because they have recorded 12.5. Okay. They have recorded 12.5 as loss, but it should be 2.5. Okay, so I want to bring it down to 2.5. So I need to reverse whatever entry they have done by 10. I need to reverse it by 10 because they entered 12.5 instead of 2.5. So as far as losses is concerned, because this is a loss for us now. So ordinarily, loss, you should debit P&L. We should debit is a loss. But because what I'm doing is, these guys have over recorded that loss. They recorded 12.5 instead of 2.5. So I'm saying, okay, this loss is too much. So I credited that loss, that P&L, through my retained earnings now with 10 million, just so that I'm bringing down what should be debit, what should go to P&L to 2.5. So I'm crediting it because what they had done is they debited P&L or retained earnings with 12.5. They actually debited with 12.5. No, it should not be with 12.5. It should be with 2.5. So I credit it to reverse that by 10 so that it's really 2.5 that is reflecting. Then, of course, this loss will impact our trade payables. They will have credited trade payables to bring it up to the new figure. So I debited my trade payable by the same amount just to bring it down to 2.5. And that's all for this. That's all for this. So how to confess? This is not a very, it's not a very simple exam. It won't be easy like that for you guys in the exam, but best of luck.
Especially because students would have the first thing they will get is a shock first. To even
Yes, that
start
shock
think
is
to,
there.
to even start thinking, they will be in stunned first. That is it. That is
Yeah.
the headache with this question.
Yes, and this is not
They'll
a
be so
very
stunned.
simple. Yeah, this is not a very. It's not a simple exam. It's simple, right, for your level.
That
It's
is the
assumed.
entries. Yes.
Yes, but the challenge with you guys is that a lot of you don't know double entry, and this one requires that you have to do double entry. You have to. There's no way you can do this adjustment if you don't know. So a lot of students don't know. So people failed. Some people got 0/18. Not some people, a lot. 0/18 because they don't know understand all of these things. They just want to compute goodwill and go. No, okay. Pass double entry. So it's not a simple exam. So Mr. Kazim will solve a lot of questions like this with you guys. So he has informed me he'll be needing some days on Sundays to solve questions like this with you, just to get you ready beyond just consolidating. Okay, that's the first one. If you revise it, you will get more understanding of it. So let's go to the second one, which is impairment. So here now, the guy bought a warehouse some years back because that's 2016 is many years back because we're in 2023 already. If I want to count it, that's how many years ago? 17, 18, 19, 20, 21, 23, because we're in September 2023. So 1 year ends in September 2017, September 2018, September 2019, September 2020, September 2021, September 2022. That's 6 years ago. So they bought it 6 years ago for 180 million. Now, the warehouse is depreciated over 20 years, no residual value. So at the beginning of this year, this current year, due to a rise in property prices, they revalued the warehouse to 210 million. They recorded a surplus of 84 million. No transfer were made between evaluation surplus and retained earnings under the Gambian gap in respect of depreciation. Okay, good. I would come back to that. However, there was a slump in the local currency market in Gambia recently, so an impairment review was undertaken at the end. The house is now assessed to be 60 million. Therefore, a charge of 90 million was made to profit or loss to reflect the difference between the carrying amounts of the warehouse of JMD and the new value of 60 million. Okay. So what is wrong with what this guy has done here? What is wrong with what he has done in the first place here? The only thing here is this. I mean, there was a evaluation surplus here. The value was 180 million, but now it is now 210 million. So there's a evaluation surplus of 84 million. So you don't have to check whether we computed the evaluation surplus very well or not, because he actually did. He computed it very well. But you can check if you wish, but it's not necessary in the exam to be checking whether he has anywhere he has heard. It will be very clear. They will tell you it's more of accounting principles that they want you to correct than calculation. So this one, he computed it well. And just to let you know that he did it well, if you do 180 million divided by 20 years,
By 200.
multiply by 6 years, yeah.
Yes, it came to 54 million.
Yeah, so if you deduct that from 180 million,
Came to 126 plus 210.
minus 210,
That is it. That is it. Yeah,
that's
it's
the
correct.
84.
It's
So
correct.
you
Yeah.
actually did it correctly. So I mean, you would not necessarily, but you might want to check if you want to the exam. But the only thing he did not do correctly here is this. They said no transfer are made between evaluation surplus and retained earnings under Gambian GAAP. So IS 16 Nigerian GAAP requires excess depreciation, which we call transfer between evaluation surplus and retained earnings. We do it in IS 16. So for them to mention that they don't do it here, that means they want you to do it. That's the only thing we need to do here additionally. So because when you have evaluation surplus, IS 16 says that optionally, it's not compulsory, even in IS 16, it's optional. It requires that you can earn your evaluation surplus annually through your retained earnings every year. And so you earn a particular amount. And the way we do it is just the evaluation surplus divided by the remaining useful life. Whatever you get. So every year you'll be transferring it from evaluation surplus to retained earnings every year. And the reason for that is that, you see, when we revalue assets and we have a evaluation surplus, it usually goes to OCI and it ends up in equity, which is a reserve. So it will be there because it's a reserve, it's just there. It's just there. But you see, the assets that gave rise to this reserve, we keep depreciating these assets. The carrying amount keep getting closer to zero every year. That at the end of the useful life of the asset, it becomes zero. But the evaluation reserve on that asset it is still be in equity. It will still be there. So it's always a problem for us. And we believe that that evaluation surplus that is going to OCI and reserve, based on the fact that we are saying that this is not a gain that should go to P&L, this is a gain that should go to reserve because we have not earned it. Okay, so then at what point do we earn it? So that's why IS 16 introduced what we call excess depreciation, or transferring from that surplus to retained earnings every year, just to start earning that revaluation surplus. start transferring it to your P&L through your retained earnings every year in such a way that at the end of the useful life of that asset, when the asset carrying amount is zero, the revaluation surplus in the books will also be zero too. It's just to avoid mismatch and to fully comply with accrual basis. So why they make it optional is that I mean, you can as well wait till the end of the useful life of the asset. Then at that date, when you see that the asset is no longer in your books, then we assume that you will have probably earned it. You will have that surplus has become earned. Then you then transfer it to retained earnings at that date. But we believe that's against accrual. It's not strictly complying with accrual. And again, it's optional. So that's the brief about these requirements in IAS 16. So the way I corrected it here, so that impairment, I said transfer can be made between revaluation surplus and retained earnings in IAS 16 if the company chooses to. Like I told you, it's not compulsory, it's optional. So this is usually done by dividing the revaluation surplus by the remaining useful life of the asset. So the adjustment for this transfer is, I call it excess depreciation. That's what we call it. So I just took the surplus divided by the remaining useful life of these assets, which is 14 years. So I got 6 million. So I debited evaluation surplus, I credited retained earnings. So I just did what it did not do. So being recognition of excess depreciation. And that was how I corrected that. So that has been corrected. If you don't know that you know it now. If you don't understand it, you can listen to this audio again. So they now said, however, so now this guy recognized, they said the value of the asset is now 60 million. So he recognized 90 million to P&L, which is the difference between the carrying amount and 60 million. So how did they get this 150 million? See, I tried to check it over and over again. I could not easily determine how they got it. So I did mine. I did mine. So I said, as at September 2023, the carrying amount of the warehouse should be 210 minus subsequent depreciation, which is 15 million, because the value at the beginning was 210, the remaining useful life is 14. So if you divide that, it gives you 15. So 210 minus 15 should be 195. That should be the carrying amount of this asset at the end of the year. So I don't know where they go 150 million from. We have 195. So since the new value of the asset is now 60 million, that means the impairment loss should be 135, not the 90 they recognize. So because this one has a lot of things around it, the first thing I did is that 90 they recognized, I de-recognize it. I reversed it. Because ordinarily impairment loss, they will have debited impairment loss and credited assets. That's double entry for impairment. I reversed that just to nil off that 90 they have done initially. I debit it back to asset, I credit P&L back first. Then I do the proper adjustment that should be done. So because there was a previous, don't forget, there was a previous evaluation surplus on these assets. When we have that scenario, any further impairment loss must be, we'll hit it against revaluation surplus first. And don't forget that the revaluation surplus was 84 million. And we have transferred 6 million from it through excess depreciation, so remaining 78. So now that we are having an impairment loss of 135, 78 first will go to OCI. We'll go to evaluation surplus first. Then any excess over that 78 million can then go to P&L. So since the loss is 135, so we still have an excess of 57. So that one goes to P&L as impairment loss. Then we credit the assets with the total. This was the right entry that we passed. And that was how we corrected that. That was how we corrected that. So that's the second part. We're almost there. The third one, which is the financial instrument. They said April 2023, this guy, Mansa, he bought 5 million shares in his local quoted company for 7.7 GMD per share. Okay. They said this represents a 3% shareholding. The intention of the company is to hold the shares until the end of this current year and then sell for a profit. The shares have been recognized at cost in the statement of financial position in accordance with the Gambian GAAP. The market value of the shares at the end of the year is 12 naira. Under the Gambian tax rule, income tax is charged at 20%. Okay. So what is wrong here? What is wrong is that the shares were recognized at cost as at the end of the year. That's wrong. You see, this is a financial asset. Yeah, and it's classified and measured at fair value through P&L because this guy is holding it for trading. He intends to sell at the end of the year. And so it should be measured at
fair value.
Yeah, at fair value, which is 12.5 at the end of the year. And any gain should go to P&L. Going to P&L is because he has the intention of holding it to the end of the year. So that's holding for trading. So, and that's fair value through P&L. I think we have done that in this class. So to correct that, this is how we did it. We said that this equity investment should be measured at fair value through profit or loss. At 30th September 2023, the financial assets will be measured at this, right? So, and I said the cost of the financial asset was this because they bought it at 7.7. So that means the cost is this. So you'll have made a gain of 24. You'll have made a gain of 24. So what we need to do is that since they record it in their book at 38.5, so we need to increase it to the new fair value with this gain so that we take it back to 62.5 as it should be. So I debited that financial assets with 24. Then I credited the gain to P&L 24. So being increase in financial assets and recognition of gain on investments. Recognition of gain on investment to P&L. And that's all the corrections that need to be made as far as this one is concerned. Finally. Provisions. On October 1st, 2022, which is the beginning of the year, Mansa signed an agreement with the Gambian government for exclusive rights for the next 20 years to supply the red t-shirts for Gambia National Traditional Festival. Right. That's an intangible asset. Okay. So they said the cost of buying these rights was 42.5 million, which are recognized as intangible assets. That's correct. That's correct. That's correct. So they now said under the terms of the rights of agreement, he has to replace the shirts at the end of 20 years. And that means he needs to make a provision right from today because that's like a decommissioning costs for the assets. There's a cost you will incur in the future. And he has to, based on the agreement, because under the terms, he has to replace all damaged shares at the end of 20 years. So it needs to make provisions, debit the intangible assets today, not even, he has to do it today. At the date of recognition of that, he needs to know, okay, he needs to estimate, according to IAS 37, he needs to estimate, okay, how much will it cost me to replace all these damaged shares? How much? So when he now gets that future amount, he will then discount it to present value, because we don't recognize future amounts in our books. It's PV. So let's see what this guy did. He said there's a 40% probability that the eventual cost of replacement will be 75 million, and 60% probability that replacement cost will be 50 million. Okay. So IAS 37 is clear on this. So we have to take the weighted of the two. Since there's a 40% chance that, okay, we incur 75 to replace 60%. So we'll take the weight. What I mean by the weight is 0.4 times 75 plus 0.6 times 50. Whatever you get is the weighted. That's what we recognize as the future cost. And then that will discount to present value. But what did he do? He said, for the prudence's sake, he recognized 75 million, which is wrong. It should not be 75 million. We need to reverse that. You cannot recognize 75 million. IAS 37, based on their own gap, maybe it's right. But based on IAS 37, first, you get the weighted average of this. Since they have given us probability of this, probability of that, we get the weight. We now discount to present value. All right? So that is what we debit to the assets with credit provisions. And it will not stop there, because this we are doing at the beginning of the year. That means that at the end of the year, that provisions, since that provision is based on present value, at the end of the year, we need to unwind the discount through finance costs, to debit finance costs with credit provisions. So those are the two things that need to be done. This guy didn't do that. This guy didn't do that. So we have to do it. So they gave us this pre-tax discount rates of 8%. So let's go and see how we adjusted for that. So I think this one has the longest adjustments, like almost 5 adjustments that I did. So provisions. So IAS 37 requires that a provision equivalent to the weighted average of the obligation should be made. That is 40% times that 75, 60% times 50, and that's 60 million. That's the weighted. So at inception dates, the present value of the provisions will be recognized to take account of time value of money. Since this is a future cost, we discount it. And they have given us the pre-tax discount rate as 8%. So 60 million times 1 plus r raised to power minus n, which is 20 years. So 1.08 raised to power minus 20. If you punch your calculator, it gives you this, 12.87 million. It is this that we're going to debit our intangible assets with, and we're going to credit my provisions with. Debit intangible assets, credit provisions. This is the correct thing. But what did this guy do? What this guy did was that my guy even, in their standards, he actually recognized a provision, but he debited
Excessive.
P&L. He debited operating costs. No, IFRS requires that you debit, and not all provisions are debited to intangible asset, like I'm explaining. The reason this one is attributed to an intangible asset, that is why I'm debiting intangible assets with this. Ordinarily, if it's other provisions, whether you have a legal case or you have some, those ones are expense. But because this provision is for an asset, you capitalize, you credit provision, you debit that asset. This guy debited P&L, so that's wrong. So what I will just do with this, I will just derecognize it entirely. so that I just do it afresh because there's a long thing. So back to provisions. So I debited intangible assets with this. I credited my provisions with this. So, like I mentioned to you, at the end of the year, we need to unwind the discount, which is 8% times the opening value, which is 12.87. So that would be 1.03. So unwinding the discount, we do it through finance costs. So we debit finance costs, we credit provisions. We debit finance costs, we credit provisions. So being unwinding of discount. Therefore, my intangible assets, remember they bought it for 42.5. Okay. So I had 12.87. So it gives me 55.37. Since the right is over 20 years, so I amortized it over 20 years. So I have an amortization of 2.77, which this guy did not do. So I debited P&L. I credited intangible assets like this for depreciation, being amortization of intangible assets. So the only thing it did was that 75 million. Then all I just did was just to derecognize it. I debited provisions, he will have credited it. Then I credited operating costs because he will have debited it. So being the recognition of wrong amounts, I'm posting. Okay. And that is all for the adjustments. That is all. That's 18 marks for you. If you are good with all of these things, I mean, as an accountant, you guys are going to be an accountant, so you have to be good with all of these things now. You need to practice these things and get to. So, I mean, if there's somebody telling you that this question 1 is about foreign subsidiary, no, it's not. Yes, that Gambian company is a foreign subsidiary. Yes. But the question itself is little about, consolidating that foreign subsidiary. It is more about IFRS adjustments, understanding standards. It is more about that. That's what gives you the 18 marks. So what I then did here, which you would have to check, is that I updated the statement of financial position of that company. Okay, I took his figures, all the adjustments we have made, then this is the updated figure. So the one I said add back, the one I'm supposed to add. So let me show you one by one. Let me just show you few ones. So like this one now that I said debit equipment, then credit payables. That means I will add this 10 million to equipment. I will add this to payables. Let me show you. So I added to equipment and I said workings 1. If you go to payables, I said credit payables 2. That one is under current liabilities. I also added to payables workings 1. Let me show you the second one. This one, I credited depreciation. I debited accumulated depreciation. So since there's no P&L here, depreciation will have flowed to retained earnings. So I'll just simply go and credit retained earnings. Then I'll debit the assets. All right. I'll use this opportunity to increase the assets with that 500. So I added 500. Since I said debit accumulated depreciation, so it's as good as I'm adding it to the assets because, accumulated depreciation ordinarily would be deducted from the cost of an asset. So now that they are now reducing it, it's like you're increasing the cost or carrying amount of that asset. That's what you're doing, and which is why I added it here. And my retained earnings, where is it? Yeah, my retained earnings. Yes, this is my retained earnings. I added that 500 also to it, since they said I should decrease my depreciation with 500. So it's as good as increasing your profit. Since I'm decreasing my expense, like I'm increasing my profit. So I added 500 to my retained earnings. Let me show you one more. Then the third one, I debited trade payables, I credited retained earnings. So that means I would remove 10 from trade payables. I will add 10 to retained earnings, which is this. So my trade payables, so I removed 10, then I added 10. So I just look at it. Just look at it. So that's how we adjusted for them all these adjustment I did one by one. And this is all they need you to do in that exam, because you need these updated figures, these updates. And the reason why you need this, and I said, I need to close, because this is part of my report that is, and I said, following from the above, all the necessary adjustments have been passed to ensure the accounts of Mana Konko Limited are presented in line with IFRS. Best regards, Financial Controller. You can sign if you want. And again is that you will see that the updated figure is still balanced. Total assets is still equal to mine. It has to balance, because double entry is what you are passing, double entry. If it doesn't balance, obviously you will still move on, but something is wrong somewhere with your workings if it doesn't balance. So you need to sit down and look at this one. You even have to look at it, because you come out in your exam, Mr. Kazim will teach you more. So this particular question is very important for you, and you have to go and look at it tonight. Otherwise, you will forget everything I've explained. That's how the brain works. We forget. So yeah. So I'm done with this one, 18 marks, which is the major part of this question. This one is very straightforward. The 12 marks is like a bonus as far as I'm concerned. So prepare a revised statement of financial position of Mansa Konko that will be suitable for consolidation. So that means that GMD, translate it to Naira, which was why they gave you this exchange rate from GMD to Naira. Of course, Naira is more valuable, as it should be now. Naira is more valuable. So that means all of those GMD figures, we're going to be dividing it by this. Now, you see,
Please, I have a question there.
okay.
The B looks very complicated though, because it seems as if they say IFRS. So that means it's the adjustment you made in A that you should use to work.
Yes, now.
So if the A is not
this.
okay, that means the B will collapse.
Oh, definitely. It won't be. Your B will not be okay. But again, is this, your exam does not mark figures. They don't mark figures. They mark methodology. So even though if your figures here are wrong, but if you understand the fact that they want you to translate and you do this, you will get most of the mark, if not all. So at this stage now, the guy will not be looking at your figure anymore. He's looking at your translation and he's giving you marks. So they don't mark figures, they mark methodology, your steps. So the figure is little, whether your account balance or not, is little, is your methodology. They give you mark for that. One, and your explanation. Like this one now that they ask you to explain, and they say show all workings. They know what they are saying. That explain, show all workings. They know what they are saying. So because that's what they would mark for you. Not so it's not complex, it's straightforward. So I translated everything at the closing rate. Everything. Because some of these PPE were remeasured. There is it. So I use closing rates. The intangible assets, Since I amortize it at the end of the year, I use closing rates. The financial investment, since it is at fair value, I use closing rates. The current asset, I use closing rates. So use closing rates. I mean, it saves you the energy of getting exchange difference, because if you use different rates anywhere, your account will not balance. It's not possible. So you'll be having difference of, you call it exchange difference. And here, it's just okay to use closing, because most of them were not, they didn't give us sufficient information to be able to say, okay, this one is historical, this one is closing. So both all the, you see, what I taught you is that monetary items, you translate them at closing rates. Non-monetary items, which are like PP, intangible asset, and the rest, they said that one depends on whether the asset is measured at historical cost basis or whether the asset is measured at fair value. If the asset is measured at historical cost, then you translate it at the historical rate. If the asset is measured at fair value, you translate it at the rate existing when the asset was remeasured. So just, and most of these assets were remeasured. So I use closing rate for everything. You find out that the account simply balanced. I'll get my 12 marks and move forward. So this is the part where Mr. Kazim is going to take more of his time to teach you. So as far as Masankoko is concerned, it's a foreign operation. So he will teach you all of this, because these retained earnings now, when he's teaching you, then he will be talking about, okay, which one is pre? Here, they didn't give us anything like that, because the examiner wants you to use closing for everything. Because pre-acquisition retained earnings, that one you translate it at historical rates, then post at closing rates, and share capital, it will tell you that the date they raised the money. I mean, so mostly for us here, closing rate is just good for us. So it will take it from there on how you translate all of this. And when you have translated, then you consolidate. That's when you then calculate goodwill, all of the exchange difference, all of those exchange difference, maybe not. Goodwill, retained earnings, and these other ones also. It would teach you that. And I've told you that I should teach you immediately. Since I'm teaching you this one, he has also suggested that he's going to be teaching you that, so that it's still fresh here. You can easily apply that knowledge there as well. Okay, and that's the end of this question and this standard. So of course, solve more questions around this. So as it stands now, I'm done with accounting standards, except if you have time. I have two short standards that I want to teach you. Two short standards. Number one is IFRS 8. Number two is interim financial report. So those are reports, but I mean, we just need to have a day like this, then discuss it. I mean, we need to fish out the time. But priority on my list now, two topics are priority for me right now that we have not done. Number one is ratio. I will prioritize that. So next week, I'll be teaching you ratio. Ratio is 20% of your syllabus. And in the past 4 diets, it has been coming out steady. Okay, it has always been, before now, they were interchanging ratio and EPS. So a diet they will have EPS, another one they will have ratio, but back to back now it has been ratio. So EPS, learn it. Mr. Kazim has taught you, learn it. You could see it there, but ratio, prioritize it, which you're going to do next week. So next week, my focus will be on accounting standard. My focus will be past questions. So I know that not all of you do. Most of you that are doing SFM, case study, we have talked about ratio. So I won't be coming back again with those formulas again. I will go straight to past questions. We'll solve last diets. If you can discuss like 3 diets together next week, just to show you how you actually solve those ratio questions in ICANN exams, in CR to be specific. Of course, doing that, I will have also taught you all those ratios as well, but it will be past question focused. So that we'll do next week. It's 20% of your syllabus. So when we are done with that, then we go to another 25% of your syllabus that we have not done, which is called disclosure of non-financial information. That I'll be doing upper week. That's when I'll be teaching you sustainability reporting, integrated reporting, CSR, corporate governance. So, and we'll solve past questions. So over many diets, it comes out because it's 25% of your syllabus, of course, including ethics also. But last diets, they didn't ask it. They came in with a shocker. It didn't come at all. It won't be like that this diet will be there. So I will do that, and hopefully we'll finish it in a day. If you don't finish in a day, we'll continue the next week and finish it. So if I'm able to cover those two, then with everything you have learned to date, you are good. You are good. But I will still continue the class. I would then teach you that interim and IFRS 8. Then when I'm done with that, then we'll start. If you still want to continue to join this class, it's optional. We'll start solving past questions. There are some questions I've been promising I want to send that I did not send. Ultimately, we'll start solving them together here. So I'll now, since I didn't send it to you, we'll just continue our class here. It doesn't stop. Nothing stops us from continuing our class till even the week where you want to write your exams. So what we'll just be doing is just past questions. We will just be solving these past questions together, because ultimately you will find these past questions you will find in your exam. If you don't solve past questions, there's a high likelihood that you will not do well in that exam. So solve past questions, solve more advanced questions like that. So yeah, the journey is too far, but the time is very, very low, and we'll maximize our time very well. The ultimate aim is that everybody that we are teaching here, I need every one of you to pass these exams, which we are still going to also talk about how not to fail. I mean, just pass, get 50 marks minimum and pass, don't fail. So of course, in our ending classes, when we start solving past questions, then we'll be talking about how to ensure that you don't fail this exam. Just pass, don't fail. So would emphasize on that. As far as today is concerned, we are done. Thank you very much. See you next week.
Thank you, sir.